Good morning, everyone, and welcome. This is Joe Scarice, founder and host of the Creative Bird Strategy House here on Clubhouse, and founder and host of the Creative Bird Strategy podcast here every Saturday morning, 8 a.m., every Sunday morning, 9:30 a.m., providing education, networking, and strategy. So we'll get started here in a few minutes. We'll invite some people in just a few and get going here. We're going to have a great subject discussion this morning. We'll be discussing debt service coverage ratio, the good, the bad, and the ugly. So if anybody has obviously any questions, we'll post them in the chat. Get started here in just a few minutes as I get inviting some people in here. My thumb needs to work a little quicker with the phone, but hey, what are you going to do? But rainy morning here in the Philadelphia market. A little downpour, thunders, and lightning, but it's looking to clear up a little bit. So hopefully we'll get some sunshine. And we'll get going here. Just a few. We had a great conversation yesterday with our moderators. Very intense discussion in strategy. So we'll hopefully be able to fulfill that same relevance today. Very interesting market we're having this past several weeks, with a presidential debate, which kind of put the market into a little frenzy in a good way. Rates are still staying elevated above 7%. I just don't see rates making any drastic moves in the favor of home buying anytime soon. But in regards to the investor space, that's where we're going to really kind of hone in and sharpen our tool shed here this morning on debt service coverage ratio. And debt service coverage ratio, the irony is, and I try to best explain this when I teach the CE course, but first, let me go into our sponsorships and our sponsors and recognize them as always. I want to thank Perkatech, Mr. Yardell Perkins, our social media strategist, our support staff and business partner in the podcast, the Creative Bird Strategy podcast. Please sit down with him to have that strategy discussion in your social media profile, website, graphic design, and artwork. I'd like to thank Realty 4-in-1, Linda Pelagas, national publication for real estate insight, information, and blog, and then also providing national events throughout the country: Philadelphia, New York, Florida, LA, Texas, Denver. And I'd like to thank also MB Capital, the unsecured business line of credit program, providing unsecured business lines for real estate professionals throughout the country. And then Lendmark Capital, your asset-based lending specialist that provides DSCR, long-term and short-term, fixed to rent, fixed to flip, new construction, and multifamily / mixed use. And I'm a senior loan analyst there as well. And then I'd like to thank TCS Property Management, where my real estate licenses are held, providing property management joint ventures and partnerships and management services, East Coast, Eastern Mississippi, and growing. So if anybody has any questions in regards to TCS Property Management, please reach out to me, or any of the other vendors, please reach out to me and I'll make the proper instructions to the proper parties. So DSCR, the good, the bad, and ugly. I did put an article this past week up. I typically now put an article on LinkedIn, link that back to Facebook as well, and share that out into some other of the websites to tie into our discussions the weekend ahead. Debt service coverage ratio is a key metric used to assess an entity's ability, or the real estate, the asset ability, to service its debt. It calculates dividing net operating income, NOI, by total debt service, where debt service includes both principal and interest payments. And I'm going to give you a little breakdown of the good, the bad, and ugly aspects of DSCR. The good, a financial health indicator to the subject property, operational efficiency, and risk management. The bad, over leverage, income volatility, and operational costs. The ugly, economic downturns, poor management, and over-reliance on leverage. DSCR is a crucial metric for evaluating an entity's ability, or the property's ability, to meet its debt obligations. However, it should be used in conjunction with other financial indicators and qualitative factors to provide a comprehensive picture of financial health. Proper management, risk assessment, and economic forecasting are essential to maintain a healthy DSCR and ensure long-term financial stability. What that says to me, I don't think investors are looking down the road that potentially rent will not increase and costs will increase. And DSCR could diminish in time, meaning that almighty 1.2 ratio could turn into a negative one, less than 1.2, if you don't carefully foresee unforeseen costs coming ahead. And I think enough people now look at cash on cash return as well as DSCR to equate what the cost benefit is, maybe not to over leverage the property. Maybe 70% is enough. Maybe 75% is being a little zealous. Maybe 80% is being ridiculous. So you need to kind of think about what do you want to make per door, even though the debt service works. So the debt service is 1.2, but are you making $300, $400, $500 a door on rental income? You could be at 1.2 debt service coverage ratio and only make $200 a month. That's completely possible. And is that enough for you for all the investment made into that property? Up and above the appreciation and depreciation that you'll take tax-wise over the next 27 years of ownership. So you got to weigh out the cost-benefit relationship to debt service coverage ratio. It's, success in real estate investments depend on choosing the right financial approach. And debt service coverage ratio loans are the key option, especially for single family through 25 units under 3 million. They're basing a lot of their numbers on the DSCR ratio. And most direct private lenders, that's what we specialize in. We offer and guide to help investors use those financial tools effectively. DSCR equals monthly rent divided by PITIA, principal, insurance, taxes, principal, interest, taxes, insurance, and association fees, whether it's a townhome or a condo. Why do investors prefer DSCR loans? Why? You don't need tax returns. You don't need pay stubs. You don't need W-2s. You don't need 1099s. It's a full asset-based loan. We look at the lender looks at bank statements, your credit score, the DSCR of the property, what have you put into the property in renovations, an appraisal, justify the renovations to the appraisal, acquisition time. Now, most DSCR lenders are looking anywhere from, it's the best way to explain it. There's a 3-month seasoning product. There's also a 6-month seasoning product. You could start the refinance at 2 months or 5 months. Are the rates better on the 5-month program than the 2-month program? Yes, somewhere between 3/4 of a point to a point. But does the rate really matter if the debt service works? Or do you need your money sooner than later? Or do you need it out of the hard money or bridge loan that you set up with either the lender that you're doing the DSCR loan with, or is it a private loan through a private investor of yours? And is the clock ticking? Is there another opportunity that presents itself? There's a lot of advantages to the DSCR loans. The lender does not get caught up in your personal debt to income. They look at the credit score. I know a lot of people that have a high DTI, but their credit score is 760. So I just look at the 760 credit score as a lender in the direct private lending space for DSCR. I don't look at the DTI of their individual personal income to debt. I look at the DTI of the subject property. So you need to prepare your own DSCR worksheet to make sure or assure those numbers work before whoever you discuss DSCR for the good, the bad, and ugly discussion in your subject property or your client's subject property. Good morning, Amy. Welcome. Brief overview, who you are, what you do, and thoughts to the discussion this morning. DSCR, the good, the bad, the ugly.
Good morning. Thank you so much for having this room. I am Amy Polvito. I am a founder and CEO of a real estate technology company called Tax. I'm also the chairwoman of the U.S. PropTech Council, which PropTech is real estate technology. We have over 800 members in council, and we just started the council earlier this year, like late January. So we're growing super fast. And the council is for anybody in real estate, any prop tech company, anybody investing or wanting to invest into real estate or real estate technology. That's what the council is for. But I have been a very long time real estate investor since 2008 is when I started real estate investing. And I used tons of DSCR loan, even through my latest when I was managing a fund and buying thousands of units of multifamily across the United States. So, about the good, bad, and ugly DSCR loans is as an operator, you need to understand that while, yes, you may qualify for that DSCR loan and they might be only asking you for 1.2 or 1.3, depending on the age of the asset that you're buying. What is not counted in a DSCR loan are your things be withdrawing from your cash in order to maintain that property. So your CapEx reserves, your operating reserves, things that you are going to need to maintain that asset. So my advice to you is the older the asset is, even though the lender is not asking you to raise the DSCR, you should anyway before you buy it. So if it's a 60s or 70s or 80s product, it should not pencil for you if the DSCR is 0.5. Because you are going to have expenses that are going to show up and rear their ugly head that you will not be able to pay for. And therefore, you might violate the terms of your loan because you did not maintain the property. And so you cannot expect that the property will maintain itself at just the rent that's coming in. And so the caveat of that is if you walk in with plenty of cash and cash reserves anyway, then you don't need to worry about this. But a lot of investors don't have that ability, right? So you want the property to kind of maintain for itself. And you want to always have to be, reserving cash over reserve cash if maintain it. So if everybody understands that, but that's my half a nickel on that.
Or a dime. Never know. It all depends.
Yeah.
Well, it's Amy. You brought up a good thing, a subject, but I want to segue real quick. How's the Prop Tech Council going?
Oh, it's super good. We just had a great event in Dallas, where it's around residential real estate, but one of our members of our board of directors is on CoreLogic. And CoreLogic is, if those of you who don't know, the back office engine for over 1.2 million real. They handle 80% of the insurance claims, also 80% of the mortgages. So they have a ton of data on mostly residential single-family homes, but they do some commercial too. And so we got to go into their Discovery R&D Center and just look at all the data they have, look at things that they're creating using AI, and invited probably a dozen startups that are in the real estate space. Ken went there, Joe, and some the National Association of Realtors was there. They had their innovation and strategy team there, so it was great. It was super good to kind of see what everybody's doing and network and all those great things. So that was our latest event that we had just on Thursday.
Yeah, I saw that. I saw some pictures that looked really a lot of fun. Ironic enough, I just signed up to be a vendor slash CE speaker at NAR in Boston in November. Yeah.
Cool. Yeah, you should meet Dan and Alex. They're good people for sure. But yeah, no, it's. Are you going to the IOI summit in Chicago?
No. My schedule this year is pretty straightforward. I mean, I have Think Realty in Orlando. I have the Maryland Association of Realtors, the Delaware Association of Realtors, NAR, Ohio RIA, and Triple Play, and then I'll jam in some other regional and local stuff in between a lot of that. There's only you only can do so much.
I know.
That's a lot.
For sure. It's a lot. Yeah, no,
right there, that's a lot.
Yeah, you should look at my calendar. I 30 because we're trying to really promote the council, and so I have like 30 conferences just between Yeah, for this year alone, like I'm traveling all the time. It's crazy town.
Well, you
But yeah.
definitely want to go to get to the NAR event. That's going to be good. That I mean, there's
Yeah.
probably going to be between 12 and 15,000 real estate agents at that meeting this year, I would say. Yeah, would definitely want to be present for that. So that's November 2nd, no, 5th to the 8th or something like that. So it's like Ohio RIA, and then I got to be at NAR in Boston, which is going to be got a lot going on. So, but congratulations on another successful event.
Thank you.
So Amy brought up some good points. You know, I don't think investors emphasize enough on themselves reserves, the 6 months reserves per property. Like that's a very serious number you need to keep into consideration. Like, why aren't you taking that more seriously for yourself as a client? What, like, do you have 6 months reserves to survive if you lost your job today or you took ill? You got to think about all that. Okay. It's the same thing with the health of real estate as the health is for yourself. Do you have reserves to sustain the what ifs? And you need to think about that for a minute. Amy brought up some really good bullet points. PITIA reserves of 6 months. What about your reserves for unforeseen for expenses? Are you really escrowing that percentage that you're backing off on the rent toward maintenance? Like, are you really putting that 5% to the side per month? And is that enough, depending on what type of property that you own? Okay, well, some properties need a little more TLC than others. I've seen a lot of properties go sideways over the last 24 months, not because the lender misevaluated the DSCR. They misevaluated the reserve and the strength of the borrower in managing the property out once they took on the DSCR loan. The DSCR worked at the time they showed enough reserves, but the client exhausted themselves with too much inventory and stretched themselves out too far, or was self-managing, or had poor property management, or had poor property maintenance, or poor workmanship done on the properties themselves, where people had to go back and do additional work, and those properties became toxic. I've seen this in every major or minor or smaller MSA throughout the country. I'm not just seeing it in Philadelphia, I'm seeing it everywhere. And you can't blame the lender following the closing because they did their appraisal. They evaluated the rental market value. They evaluated the value itself. They evaluated the lease. Now it's up to you to manage and maintenance that property. DSCR is only as good as you maintain that property. It could be zero if you don't maintain it correctly. And you could go into foreclosure. Okay. So we're starting to see some foreclosure action in the DSCR space because of poor follow-up by the client following the DSCR loan. They don't maintain the numbers, or they were fictitious with the numbers, or they were zealous with the numbers, or they didn't realize the maintenance on that property was more, or the insurance jumped up 3 times. There's a lot of moving parts when it comes to DSCR. And, you know, I just saw an article that Justin sent to me about Florida's insurance and Louisiana's insurance. I mean, it's at the near breaking point of state regulated um, insurance mandates in some of these states. It's that bad. It's really getting to the point where I don't think there's going to be an insurance carrier in some of these states. And what do you do then? Now you're regulated insurance, so your DSCR is going to be set in that insurance space. So let's talk about some hot real estate markets briefly, and then we'll keep moving on to our moderators. So this is some reports that I got as of June 1. So this is based on choosing like maybe hot markets based on value appreciation, anticipated change in home value appreciation, new jobs per new housing units permitted, estimated of net new numbers of households that own their own home, and the speed at which homes are sold. Number 1, Buffalo, New York. Number 2, Cincinnati, Ohio. Number 3, Columbus, Ohio. Number 4, Indianapolis, Indiana. And number 5, Providence, Rhode Island. Now, happy to say I've been to all 5 of these markets. I do see the better barrier of entry in that Buffalo corridor. I like Rochester, I like Buffalo a lot. I like Ithaca, I like North Syracuse. Binghamton, that would be my bottom 5 out of those New York City corridors. Cincinnati and Ohio, very hot markets, a lot of out-of-state landlording. There's a lot of property management presence there. I think the numbers are really good, but I think it's getting very frothy. So you got the out-of-state landlords and the in-state landlords going right at it for the same property. So that's getting a little more competitive. I'm seeing Akron or Dayton, Ohio, maybe some better opportunities there based on a barrier of entry. Cleveland still has a rough spot there. I'm not a big fan of Cleveland. And Youngstown as well. I'm not a fan of that. It still needs a little more maturing there. Indianapolis, Indiana, I've been there several times. The outskirts suburbs are good. Some of the inner sides of Indianapolis, a little rough around the stadium area. They're working on it. But the barrier of entry and the debt service coverage ratio works. Providence, Rhode Island, that surrounding area there, you got Amtrak, you got all the corridors up there. I'm more of a fan of New Hampshire and Maine because the migration rental reports justify Maine and New Hampshire. I'm doing a couple projects in Maine right now. Just got to be cautious of the rural settings up there. You got to stay within the city properties because the minute you go out 10 miles, you're in USDA and rural, and DSCR lenders or asset-based lenders are not a big fan of that. But I do like these numbers here in all these markets or the surrounding areas. Justin, good morning and welcome. Brief overview, who you are, what you do, and thoughts to our discussion this morning. DSCR, the good, the bad, and the ugly.
Good morning, Joe. Good morning, everybody. Yeah, Justin Jefferson. I'm in the Louisiana market currently. I'm transitioning over to Dallas and to do some things and do what I've been doing. Hopefully, definitely on a better scale, bigger scale. So yeah, debt service is something that we've talked about a bunch of times in this room. Joe, I think I think I'll spend my time talking, leaning into the point you were making with the insurance, and because in my area, and we're going into hurricane season, I think I just read something that said the hurricane was that we have in the Gulf or whatever is one of the earliest that we have during this time of the year or whatever. They're usually not coming until later on in July and August. But anyways, I think that brings back to the point that you brought up around how you need to adjust your debt service numbers. If you're investing in the Gulf, or if you're investing in Florida, Louisiana, and even Houston and stuff, and further south of that, because the insurance companies are definitely going up. There will be a need for some insurance companies are going to pull out, but I think the legislature is trying to press them not to pull out, and I think they're going to be going back and forth with each other for a little while, and they should be coming to a conclusion as to how they're going to get some assistance from the government to kind of keep to bridge that gap that people can't really afford. Of course, we're already having some levels of affordability for the majority of people in the country, but I do also believe that when you staying ahead of everything is part of investing, right? And making sure you're within the metrics that you set for yourself within cash flow and the systems you put in place, so that your property, first of all, it should always be ready to qualify for a debt service loan because it should be running correctly. But this is an ongoing thing in maintaining your investment. I believe in keeping it prepared for that, and I'll dive back into the unforeseen things like the insurance policy. A year and a half ago, for sure, and 2 years beyond, we were talking about how hot Florida was, and you could do anything in Florida, and this, that, and the third. However, people with close margins are going to find themselves being pushed out by legislature and increase in insurance rates. And so when you do that, where are you positioned, right? How are you? Is the 6 month reserves enough, or did you calculate that into your level of risk, right? Because I think that's a whole different type of underwriting. If you speak, so if I'm investing in a place like New Orleans, I need to underwrite a double or triple in my insurance. But there's a possibility that my insurance would double or triple, right? And if I look back 10 years, I can see that in history. And so I think that it's a bit of a deep dive, but I believe it's necessary with a certain class of asset in a certain area. And I think it all goes into evaluating your risk, and of course, when the numbers hit the paper, this is all going to add up to your debt service and determine how you're able to move, whether you're able to move, and whether you're able to sell it. So those are my thoughts, Joe.
Thank you, Justin. You know, this is another thing what came to mind when you were saying, Justin. I think a lot of clients don't realize the reason why DSCR loans are existing. Like they don't really understand how it all kind of comes together checklist wise. Why would I lend you full LTV or loan to value on a property that you don't have occupied yet if I'm basing everything on the physical DSCR of the property today? So I send an appraiser out there and it's not rented yet. So I take 5 to 10% off the LTV because it's not rented. I'm not looking at your tax returns. I don't care about your pay stubs. I don't care about your low DTI. I care about the physical asset, the income and expense of the asset. So if it's not rented, I can't give you all the money in the world. But does it make sense to really leverage the LTV right now if you're so hyper focused with rate? You know, like I have a rate, my base rate is around is at 7%. I get calls all the time. Hey, can I get 80% loan to value with a DSCR around 1.1 and get that 7% rate? Sure, you could pay 3 points for it or 2 points for it. Like, why would I give you the lowest rate for the highest leverage? Like, the common sense of DSCR has gone out the window already. You know, common sense for regular lending went out the window 10 years ago, but I don't people realize the logic behind what a DSCR loan really is, right? It's based on loan to value, it's based on DSCR, it's based on your credit score, and it's based on your cash reserves or liquid reserves, whether it's a line of credit. Now, again, to the advantage of DSCR, where a regulated bank does not get involved with, DSCR lenders, direct private lenders, at least for that matter, as far as I am aware of, is they recognize up to 70% of the cash out toward reserves. So if you're doing a cash out of 30 grand, 70% of that can go toward your reserves of PITIA. But that doesn't mean you spend all 30 grand and go to the next deal. You better leave that 6 months reserves for that property so you don't get over leveraged. Oh, no, I got nothing to worry about. Yes, you do have to worry about it. I think people they want the almighty shiny rate, but they want the max leverage and all the money out and no money left in the property. Eventually that well can go dry. You need to stay liquid. You need to stay fluid in what you're doing and growing. Like I work with some very active clients. They'll take a couple weeks off before making more offers to allow some of the refinances catch up with a lot of the burrs. Like they're buying properties for rehab. They're also refinancing properties. So they're balancing. They want to make sure that there's balance. So taking 2 weeks off, you're not going to miss that many opportunities, or 3 weeks off, getting caught up with all your contractors and get all that balanced out, get leases signed, get deposits, get everything into their softwares, and then ready to rock and roll for the next wave of properties. So you need to be cautious as you grow. There's nothing wrong with owning 20 properties. I want everybody in this room to accomplish that. I want everybody to have 50 properties for that matter. But you eat an elephant one bite at a time. And if you don't have the proper reserve base per property and leave liquidity available, and you maximize every LTV and then you're at every premium rate, eventually the dominoes will fall against you. The almighty LTV in DSCR that really makes the difference in rate today is 70%. Is 75% and 80% available? Yes. But is 70% the safe place to be on DSCR, on leverage, and on reserve base? Yes. I'm going to tell you that for a fact. 75% you may be a little bit, but 80% you're all exposed. It's all wide open. Anything can potentially happen to that property or you. So you really need to think this through to be very cautious if you're planning on owning multiple properties and being at max leverage on every one of the properties. So what the DSCR is 1.2 or better. Now, again, can most DSCR lenders that are direct private lenders go down to 1.0? Yeah, they could even go down to 0.80, but why would you want to do that or even brag that you can get that done? All that's telling me is that you're not evaluating the present market at hand. Oh, nothing will happen to me. Things could happen. Believe me, things could happen. I would rather be cash neutral at a refinance and make $300 more a month instead of making 200. I make 400, 500 a month, and look at the future aspect of that cash flow, that money going into my pocket. Because if I make 500 a month per door and I have 10 doors, that's $5,000 a month in my pocket every month, good, bad, or ugly, and I'm not over leveraged. You accomplish success in smaller portions in the single family through 4-family space. Now, again, if you want to go to the multifamily, like I just presented a 6-unit to someone to take a look at, to consider, hey, instead of buying 1 unit, now you're buying 6 all at the same time. It's a game changer. Does that change your dynamics of cash flow overnight? A 5+ unit to 25 unit is a business. 1 through 4, to me, is more of a practice run to get into the bigger landscape of 5 through 25. You buy a 5-unit, 8-unit, 10-unit, that is its own business. That should be in its own special purpose entity. It should be treated a little different. The maintenance is ran differently. The management is run differently. The escrows are run differently. LTVs are run differently. Debt service minimums are different and required. Are rates a little higher? Yeah, but that's the cost of doing business. If you want 30-year money and you want a DSCR and you don't want a full documented loan, that's what you're paying for in that 5 through 10 space or 5 through 25 space.
Yo,
Go ahead, Justin.
yeah, I wanted to throw this in there. You said you mentioned that it's unlikely. You were mocking the idea that it's unlikely that anything will happen. Well, I just want to take it back to 2020. Kind of when we met, right? There has not been 1 year that's been consistent enough. Not 365 days to where you could keep the same game plan. And the fortunate thing about this app is a lot of it's been recorded. So I just wanted to say that every single year we've had to be ready to pivot or pivot the game plan and strategy, even up until now, discussing insurance policy. So, I said things into this before, but because of technology and, the rate of change has increased in which we grow, right? In which the world is evolving. And so I just, it's going to happen.
Well, this is another thing. I know that all this has been recorded, so there is so much volatility and concern I have with the influx of new rentals coming to the market, class A and B, and not enough C. And there's so much C activity in the major cities where it's pushing the A and B out to the suburbs or the rural markets. And then you have these commercial conversions and you have these malls bringing thousands and thousands of units to the front line over the next 24 to 36 months. What happens to DSCR and what happens to values if there's not enough home ownership buying and strictly landlord buying, and there's a flooding of rentals into the market where the tenant has options and your potential rent can actually decrease, or you're going to have to renegotiate your leases with these tenants to keep them retained so they don't go to a better option where they're giving bells and whistles, where they're given free coffee every morning, or a gym, or a gym membership, or whatever the bells and whistles a lot of these other institutional investors are extending to their tenants to retain them. They want to get them comfy. They want to fatten them up. They want to make them lazy where they never want to buy a home themselves. They want to be coddled and catered. So can the individual landlord with the 1 unit through 4 unit or the 5 unit through 25 unit offer those amenities to maintain debt service and value and appreciation all at the same time? I'd be very, very concerned. I am concerned. Okay, I'm very concerned about that. I'm concerned about appreciation, and I'm concerned about DSCR. I'm concerned about rental appreciation. I see a stagnation in the rental appreciation right now throughout the country. I see values dropping by 8 to 10%. I'm not seeing a lot of appraisals coming in on point. I'm seeing them decreasing. I see a lot more disputes on appraisals right now. But the DSCR works, but the values are coming down, and the loan amounts are coming down based on LTV leverage allowability. Good morning, Bob, and welcome. Brief overview, who you are, what you do, and thoughts to DSCR, the good, the bad, and the ugly.
Hey, Joe. This is Bob. I help people set up corporations and LLCs. Not here to give any legal advice today.
Oh, come on, Bob. Give us some legal advice and get ourselves in trouble. Come on.
Okay, let's get ourselves in tons of trouble this morning. But anyway, so what? I mean, I'm not going to probably be speaking specifically about DSCR since I don't do lending, but what I have noticed, particularly among my real estate investing clients, and just kind of thinking along these lines, is that, and I think I touched on this a little bit over the past couple days, that a lot of I've been running into a lot of clients that are just absolutely trying to squeeze every dime, every dollar they can out of everyone they can, and then wind up over leveraging themselves right now. They're racking up debt. They're buying one property to take out a loan to buy another and another. It's kind of like the house of cards. And the one thing I keep telling people about is when you're getting into this, and it's the same advice I give to any new real estate investor: don't bite off more than you can chew. Like Joe said, you eat an elephant one bite at a time. The biggest issue that you're going to wind up with is if you have too much debt and suddenly the income goes away, you're going to wind up in a situation where you could be going down the ugly path of foreclosures. About 20 years ago, my business, we overexpanded. We started opening offices up throughout the Northeast corridor. Back in the days when setting up a company was paper-based and you had to have local people in the different cities that you intended to service. And we had offices in New York, Philadelphia, Wilmington, and Washington, D.C. with staff in all those offices. And at that time, all we did was Delaware companies, but mostly for law firms. And I had couriers running back and forth on Amtrak to take paperwork from Delaware and ferry them to the local offices, where we had other couriers that would drop them off at the law offices. And it was a great premise, and it worked really well. But unfortunately, we couldn't survive a sudden loss of a major client, which began to tip the cards over because we were locked into office leases because we had to have staff, we had payroll, and very, very slowly we had to figure out, okay, how do we dismantle this enterprise? We over leveraged ourselves not so much by taking out debt, but by signing too many leases for real estate that we couldn't afford. So after some very tricky negotiation, we got out of all that, and we got everyone out off to other jobs. We didn't believe in laying people off. We actually held on to people until we could get them to work for other companies. We were lucky we were able to do that, but it came at great personal cost to my business partner. So the point being that if you're over leveraging yourself with the debt, no matter how good your income is, and I think we all know, especially look back at 2008, look what's happening now. It's only going to take a few customers deciding to either delay payment or not pay, or some other unexpected expense coming up, and here goes the house of cards. I see it over and over again, and I've lived through it myself. So sharing a little personal experience of what it can mean when you over leverage. So yeah, it's like I said, it's all good and rosy until the bill comes due. I don't really have any thoughts specifically on DSCR other than just, be careful how much debt you put yourself into. And with that, Joe, I'm going to just yield the mic back.
So what do we actually ask for a DSCR loan from an LLC formation, Bob? Why don't we go into that detail briefly?
So whenever I get a customer that says, Joe said call you, Bob, to call me because I need an LLC, I know that Joe's going to ask what he calls the Fabulous Four, soon to be the Fabulous Five documents. He needs a certificate of formation. Some states call it certificate of organization. Other people call it the articles. He needs a CP 575 letter from the IRS, which is your official confirmation of your EIN. There are substitute versions of that. Joe wants a completed, signed, and executed operating agreement. He will also request a certificate of good standing, which different states have different names for, which proves your company is active and up to date. And the fifth item that is going to be required is going to be the new federal BOI reports, which is the disclosure report indicating who are the financial beneficiaries and operators of the business. Oh, well, that was weird. As I was sitting here, my side table just collapsed. Sorry about that loud noise. That was strange. Anyways, so yeah, the 5 documents: certificate of formation, EIN letter, operating agreement, certificate of good standing, and the BOI report that you file with FinCEN at the federal level.
Bob, you couldn't say it better than myself. I really appreciate that. So again, these are some of the initial items that I asked for, right, Bob?
No, I said thank you.
No problem. Thank you. So Bob brought up some good points where it leads into another part that I want to cover real quick. So a lender looks at DSCR a couple different ways, whether you're cashing out or not cashing out, meaning cash neutral, like you're just balancing out the payoff letter, closing costs, rolling everything in, not getting more than $2,000 at the table. That's a non-cash out. Cash out means you're getting more than $2,000 at the table, up and above payoff, closing costs, etc. Then there's LTVs, 60%, 65, 70, 75, 80%. DSCR changes between all that. And then there's the DSCR itself of going as low as 0.80 and as high as 1.2 requirements. Now, does that impact rate, all these moving parts? Yes, because it also ties into the credit score of the borrower. But it also ties back to the asset that it must be leased or should be leased at the time of the appraisal. And are we also looking at the comparative of the market rent to the signed lease? And also looking at the appraised value based on most recent comps in a very specific vicinity of the subject property? Yes. Now, again, we're still not looking at financials. We're not looking at tax returns, pay stubs, etc. But we're still hyper-focused on the asset. We're then also looking at your bank statements, self-directed IRAs, retirement accounts, CDs, lines of credit, if there's a cash out, what's coming from that based on liquid. We're still looking to justify 6 months of PITIA, principal, interest, taxes, insurance, association fees. We're also concerned about what you put into the property based on creating an enhanced value of the property. And is that something that you're trying to get reimbursed on as well? But then let's talk about the turnkey opportunity where you can just buy something, it's rented or it can be rented right away. DSCR works and you put 20, 25% down, 30% down, and see what your cash on cash return looks like as well. There's a lot of investors out there that just need to park money and don't want to go through the dirt work of ultimately working on a burr, right? It's not for them. The burr is not for them. They're not fans of burr. They don't want to be any part of burr. They just want to buy something. They want to renovate. They want to just buy it, rent it, and move on, and make cash on cash on the money they have vested into the property. I personally think burr method strategy still works in 2024. I also think that turnkey opportunities exist still in this market. I think both are relevant. I do have an article out there on LinkedIn as well. Does the burr method still work in 2024? And I would say yes, it does. Good morning, Travis. Welcome. Brief overview, who you are, what you do, and thoughts to our discussion this morning. DSCR, the good, the bad, the ugly.
Good morning, Mr. Joseph and everybody else. I'm Travis. I'm a real estate broker here in the Houston area. Been a real estate investor now since 2001. And still are a landlord of properties in other states. So I understand a lot about investing out of your backyard. We also do property management here for the Houston area. So very experienced with landlording and being a landlord and dealing with tenants and dealing with maintenance issues and everything else. So a couple of things I just wanted to bring up when Justin was talking about the insurance. And I've got a lot of hard knock experience that I've gone through myself, so I'd like to share from that. When the insurance rates were going up like crazy, where we have properties in Alabama because of hurricanes, we were looking for any way to get our rates down because they were just getting to be so ridiculous. And we went with a policy that wasn't what do you call it? The policies where they look at the actual cash value of the property, right? So those rates are lower. Well, I can tell you, man, when you're talking about having reserves, if you're going to have that kind of policy and then your property gets beat up by a hurricane, don't expect to be able to fix your property if you have a tree that falls through it, because they're not going to cover it. I mean, I'll give you an example from myself. We had two properties got hit by a hurricane. Both of them had trees fall through them. Insurance company offered us like 15, 20 grand, to get these properties repaired. And then there's no way you're going to fix those properties with 15, 20 grand. Now, if we had the other type of policy where, they actually look at what it would cost to rebuild your property if it gets damaged, then we would have been covered. But because, we went with the cheaper policy, we weren't covered. And so to this day, those houses just sit vacant, with still having holes in the roofs. And at some point we'll just tear them down. But so that's a risk to look at when you start looking at insurance rates going up and people looking for a cheaper policy. I would hesitate to go down that path again, just because you can really get in trouble. So the other thing is, when I was thinking about what you're talking about, Joe, with having to have 6 months of reserves, I'm thinking back on, have I ever had a property that sat vacant for 6 months, because of, I don't know, we couldn't rent it out or anything like that. And so I had to really think about it. And the times that we've had properties where they're not producing income, was only like what I just said about having hurricane damage, or where a tenant had declared bankruptcy. So here in Texas, when a tenant declares bankruptcy, you can't get them out. Like, I've tried and I've talked to so many attorneys, like, how can I get these people out of my property? They're not paying their rent. And basically you can't evict them. You can't collect anything from them until their bankruptcy is complete. and that can last, 4 months, 6 months. So I can see where you need the reserves if that happens, but after having hundreds and hundreds, maybe thousands of tenants, that's only happened 4 times. So it can happen, and storms can happen, but other than that, I don't know why you would need 6 months of reserves for your property, but maybe you can share some more light on that.
So, Travis, do you treat first? My question to you: do you treat your out-of-state properties any differently with reserves than your in-state? Just because you have out-of-state management, maybe handling that. Is there any reason?
Well, for us, we don't even spend the money. It just sits in a bank account. That's it.
One account.
Like we spend it, yeah. It sits in a bank account per LLC. So when we need the money, it's there. We don't distribute it to each other. It just sits there. A little bit different.
So the irony is 2008 changed a lot of requirements based on the new banking regulations, and some of that has bled over into guidelines for the DSCR. So you got to remember, a lot of people that were in the banking industry, the regulated banking industry, came into the asset-based lending space, and where they created guidelines, which is what we go by. We don't go by regs, we go by guidelines. And for whatever reason, one of the items, even though we don't collect returns, pay stubs, W-2s, or 1099s, we require the 6-month reserve because of what happened back in 2008. So I don't know if you want to have a flashback of how you felt in October of 2008, Travis, but it was pretty ugly where nobody had any reserves. They were like paper macheing bank statements together, making shit up as they went. And people got themselves in a lot of trouble. You know what I mean?
Yeah.
I mean, I saw people that went down and never came back. They lost 20 properties.
Yeah, I was managing property. I can think of a couple different landlords or clients I had that I was managing property for. And I remember him telling me, this guy was out of California. He's like, "Oh, I don't care if it's negative cash flowing a couple $100 a month." I'm thinking, dude, that's insane. Like, why would you buy a property that doesn't make any money? And yeah, he was one of the first ones to go down when 2008 came. He was way over leveraged. And I tried like heck to try to save some of his properties. I think out of the 12 he had that I was managing, I was able to save 2, but the rest were gone. So yeah, I can understand that, Joe.
Well, I think the way that the guidelines and regs look at 6 months, 3 months, the worst case, something should stay empty, right? For turnover, tenant screening, and then occupancy, right? The other 3 months of those reserves, to me, sounds like more of a, hey, we got to put some paint TLC back into the unit to turn the unit over. Like, I don't know, you weren't on the call yesterday, but Joe Martella, it's very painful for an investor to turn over a unit. They rather keep their tenant in there as long as they can, because the turnover is the painful part. To get it caught up, get a punch list together, get the punch list addressed, go through the tenant screening, identify the right tenant, get them in. I mean, that takes 2 to 3 months. I'm just shocked where people think, hey, I'm going to buy and renovate this property, and I'm going to be calling you in 4 months. The average renovation, the average renovation to hold in the country, the industry standard, it hasn't changed at all, is 7 months. So if you get it done in 4 to 5 months, that is great. That means you didn't take on a heavier renovation, and you were able to stabilize the property and get it rented. Brilliant. Prove the industry standard wrong. I want you to. I think people don't really understand DSCR enough, where the better DSCR investors are keeping their renovation costs below 50% of the purchase price. Meaning if they're buying something for $100,000, they're keeping renovations at $50,000 or below. Because when it comes time to refinance, they're able to not have to take out as much, and they're able to debt service coverage ratio more, accomplish a better rate, accomplish a better cash flow. That's the good part. The bad and the ugly is when you take on a more aggressive renovation. Time kills profitability and deals and relationships. And a GC could be the make or break of one of those renovations when it's over 50% of the renovation costs. Right now, when I see a heavier rehab, I'm looking at, I order an appraisal. I also order a feasibility study to make sure you can complete that project based on the renovation numbers they're coming up with. I want to make sure that GC and the numbers you're coming up with, the general scope of work, makes sense to get to the starting line, which is where the DSCR starts. Not the finish line. That's the starting line as well. Right? You could be at the finish line before and not get a project completed. I get clients sending me, hey, what do you think about this deal? There's 2x4s, it's electric run, ceilings are gutted. It's, and it's a stalled project that they're buying because somebody else did not do a feasibility study on that renovation for that client up and above the appraisal. And things went sideways. And that's the ugly and the bad. Because you don't even get to the DSCR stage to talk about the good. Good morning, Linda. Welcome. Brief overview, who you are, what you do, and thoughts to the discussion this morning. DSCR, the good, the bad, and the ugly.
Good morning, everyone. Good morning, Clubhouse. My name is Linda Pliagas. I'm a real estate agent, realtor in California. I'm also the owner of Realty 411. We're a news and information website, and we produce articles, magazines, events, podcasts, all in an effort to help investors with their journey. Now, regarding the DSCR loan, which stands for debt service coverage ratio, it can be a wonderful type of loan for investors because the mortgage loan officers only look at the property's cash flow income in order to determine whether to make the loan or not. Now, DSCR loans are easier to qualify for, require less paperwork, and as a result, the process is much faster. In my opinion, the downfall is part of the positives that go along with this type of loan. Now, an experienced investor may be able to determine if this is a good loan for them or not, and if buying another property is the right thing for them. But if you're not experienced by purchasing a property with a DSCR loan, you're not giving that financial expert and professional that's helping you a complete look at your overall financial health. What if buying another property is really not such a good idea? Nobody's going to be able to really tell you that. In contrast to a traditional mortgage where they want to see tax returns, they want to know all the income and expenses that you have on every single property. They want to know about your other bills too, such as your credit cards, car notes, and other expenses. Now, that, in my opinion, that's why it's so important to work with qualified professionals like Joseph, who can help guide you to determine if a DSCR loan is right for you. And also the impact that it will have on your overall portfolio and life as well. I heard a lot of talk about over leveraging. You definitely don't want to over leverage as an investor. I've been there myself. It's really tough. It can really mess up your life, not only your life, but your, relationships, your marriage, your relationships with your business partners. You definitely don't want to over leverage. You always want to have reserve, and 6 months is important. A lot of people said, oh, well, what can happen? What can happen, guys? We just spent about $30,000 on our properties the past 6 months. And those were all unexpected repairs that we did not anticipate. There was a vandalism on one property. They completely destroyed our unit. Did the insurance cover it? No, they did not cover it. Even though we fought them, we had never even had a claim with that insurance company in all the years that we were with them. They still didn't cover it. Of course, we dropped them right away after that because no, that's not the right insurance company for us and for other people if they're never going to cover you. And then we also had plumbing issues. We had a plumbing pipe burst inside one of the bathrooms, and the tenant did not tell us. And it got worse and worse. Then we had to bring in a mold specialist to dry everything out. The insurance only covered a portion of it. I mean, it was a disaster. I also evicted those tenants as well because that was due to their negligence. They did not tell me about that pipe bursting for, a while. So all that damage was accumulating. So I've gone through a lot of mishaps and repairs the past 6 months due to our rental properties, and a lot of it was due to the negligence and the destruction of tenants. And it's, really sad, but it does happen. It can happen. And that's why you need 6 months reserve, and everybody should have a reserve when they're getting into the game. And the more properties you have, the higher your reserve should be. Thank you, Joseph. Back to you.
Thanks, Linda. And Linda, can you give us an update of upcoming events with Realty 411?
Yes, we do have an event coming up August the 3rd, which is a Saturday in Southern California by LAX. Hope to see everyone there who can make it. We do have a much larger event, our signature event, October 26th, which is also a Saturday. That is the Grand Real Estate Expo in Los Angeles. We were awarded actually an award by the California State Assembly for the work that we do with that expo. My partners and I always received an award for the work that we have done for the past, 15 plus years in educating investors in California about real estate. So we're really proud of that. And that one will unite over 800 investors from around the country. So you can find all that information at realty411.com. And we hope that Joseph can join us again for the October event like he did last year. So thank you, everyone. Thank you, Joseph, for a great platform. Back to you.
Thank you, Linda. So to cap this off is you need some tools here. Okay, you need the debt service coverage ratio worksheet. You need the cash flow worksheet. You need to understand cash on cash return. You need to understand how to properly buy a property if it's in need of renovation or BRRRR. That's the Mayo worksheet, maximum allowable offer. You also need, if you have a portfolio of real estate and you need somebody to underwrite the portfolio to make sure your numbers make sense, we offer a data tape where you can put all your properties on, where we can underwrite them all together at the same time. And then finally, we offer a construction budget checklist. So if you're doing a renovation, you could document everything in the general construction scope of work, and then figure out how to set it up as a draw schedule with your contractor. We offer these worksheets complimentary. All you have to do is email me your information, your full name, email, phone number. I will send you all the information on that. I'll also send you information on unsecured business lines of credit. I'll also send you information on asset-based lending. If you need any introductions to Bob, Linda, Travis, Amy, Justin, please, by all means, I can make those email introductions. That's easy to do that. We're the only room on Clubhouse that has our own website and celebrating now close to our 50th episode on the Creative Bird Strategies podcast, which is creativebirdstrategies.com. You could download all of our past discussions, which are all played also on replay here on Clubhouse. We also the only club that offers video marketing for your business and your services. If you need some time to put together tips of the trade, an interview, and we can push it out and market it for you on your behalf. We offer the worksheets. We now offer also a CE course on asset-based lending. By the fall, we'll be also teaching a CE course on wholesaling real estate. That's coming out next for licensed real estate agents. I'm working on that now, getting the NAR approval and the state approvals for that as well. Again, I'll be speaking at various events in the fall as we come. Hopefully, I can put LA on my list of items that I'm going to be at Think Realty. I'm going to be at Ohio RIA. I'm going to be at the Maryland, Delaware Association of Realtor Expos, Triple Play. So I'm making myself very available. If there's an event that I need to kind of come to or attend, if you need a presentation on asset-based lending at one of your investor group meetings or events, please let me know. I'll be more than happy to fly out and conduct hopefully some really good insight and education and strategy. So who do we pick for our outro? Let's go back to Amy. Amy, your outro and thoughts to DSCR, the good, the bad, and the ugly.
Hey, thanks, Joe. This has been such a good room. I did want to, my outro is, I am Amy Palvido. I am the founder and CEO of Facilimax and also the chair of the PropTech Council and a long-time real estate investor for 21 years. So I would say, technology-wise, there's ways to mitigate risk on your properties. Facilimax has a kit that will reduce the major calamities on. We had the ability through technology devices to stop leaks of water, stop kitchen fires, tell you if your tenants are smoking inside the apartment or that violates ordinance. Exists today that to mitigate some of this risk for you. So I do want to let you know that that does exist. And if you want to reach out to me, it'd be great. I hate to hear any investor go through all the painful things that Linda and I and Joe, because we have longtime real estate investors, have gone through because we didn't have the tech that exists today. So if you have this technology, we'll take full advantage of it. And that's my outro. And thanks for having me, Joe.
Thanks, Amy. I appreciate that. I want to thank our moderators today. They've all gave their own personal insight. None of this is scripted. This is all very unscripted discussions every Saturday morning, 8 a.m., every Sunday, 9:30 a.m. Eastern Standard Time. And again, you can find us at creativebirdstrategies.com. I want to thank our sponsors today, of course, Realty 411 with Linda Pelagas, Yordell Perkins with Perkatech. I want to thank MB Capital, your unsecured business lines of credit referral program. And I want to thank as well as Lendmark, your asset-based lender nationwide in all 450 states. And then also, if anybody has any questions on TCS property management and services or creating a joint venture or some type of partnership with them in regards to property management services throughout the country, please let me know. I'm now a referral partner for them, and I just recently moved my real estate license over to them as well. And again, if anybody needs a CE course for their investor group meeting or their association to give CE on asset-based lending to licensed realtors, please reach out to me and we'll get that arranged right away. And my quote this morning, the best revenge is to improve yourself. Have a fantastic week. We'll see you next week, and we'll be ending the room in the next 30 seconds. And thank you.